worried that they're going to see job cuts. And of course, they have every right to be worried, because a merger and acquisition, a takeover like the one we're seeing here from Peugeot buying Opel, usually does not create new jobs. It means jobs will be cut. Now, those workers at Opel, they have government guarantees until the end of 2018. But of course, that's only just about 2 years. That is not really long term when it comes to people's financial and personal planning. So a lot of people, they are worried. Maybe not necessarily the ones working the line and specifically building the cars, because Peugeot wants to keep Opel alive as a brand. So they should be fine for a while, but it's a lot of people in administrative jobs and sales and marketing. They might see their jobs cut in Germany, jobs moving to France here, because that is, of course, a possibility where Peugeot sees synergies.
Right. Now let's look at some of the data coming in today. We have the Eurozone GDP and, of course, the German industrial orders. But let's look at German industrial orders, which, of course, dropped by 7.4%. That's in January, the biggest fall ever. That's since 2009. What is the outlook for the entire first quarter of the year?
It doesn't seem to worry anybody here in Frankfurt too much, to be honest, because even though that is a big number, 7.4%, we have to keep in mind that, first of all, industrial orders tend to be volatile. There's a lot of seasonal factors there involved, and we're coming right out of a very, very strong month for industrial orders. So even with those weaker numbers, that yes, they are a little bit disappointing here, but the government still sees a strengthening trend for the economy, and specifically in manufacturing. And if you look right behind me, of course, you can see right here the DAX, and the DAX is up slightly, not worth mentioning at just like 3 to 5 points or so, but that is despite weakness in Deutsche Bank shares. So we can clearly see that despite numbers being a little weaker than expected, that is not really much of a problem for markets today.
Right, thank you very much for your time, Lars. I guess when we'll see tomorrow, you will talk to us about the Eurozone GDP data
Absolutely.
that came in today. Right, have a wonderful day. Now, in the U.S., stock index futures pointed to a lower open amidst growing concerns over U.S. President Donald Trump's ability to implement economic policies. Now, the long-awaited legislation to repeal and replace Obamacare was unveiled on Monday by U.S. Republicans, although it was greeted with immediate criticism from the Democrats. Now, on the data front, Tuesday we'll see trade deficit and consumer credit for January released at 8:30 a.m. Eastern Time and 3 p.m. On the earnings front, Brown-Forman, Dick's Sporting Goods and Momo are among the companies scheduled to report before the bell. H&R Block, Aero Environment and Urban Outfitters are all due to report after the market close. In Asia, shares finished mostly higher today amid growing expectations among traders that the Federal Reserve could raise interest rates at its March policy meeting next week. The Australian ASX 200 recovered from a negative start early to close up 14.88 points after the Reserve Bank of Australia left the cash rate unchanged at 1.50%. Japan's Nikkei 225 lost ground, closing down 34.99 points, extended Monday's losses. The Shanghai Composite closed up 0.27% and Shenzhen Composite finished up 0.3%. Meanwhile, Hong Kong's Hang Seng Index was up 0.32% by mid-afternoon. In South Korea, the Kospi advanced 0.61% even as geopolitical and political tensions continue to simmer. And back here, investors were upbeat in the Treasury bills market on Monday, with average yield contracting 5 basis points to 18.66%. And in the bonds market, however, proceedings ended on a bearish note, with average yield expanded by 40 basis points to 16.71%. Let's get a sense of today's activities at the fixed income market. I'm being joined by a fixed income dealer with GT Bank, Chioma Udu. Good afternoon, Chioma. Thank you very much for joining us.
Good afternoon.
Very well, thank you. So what's the sentiment in the market today?
Okay, for the short end of the curve, the T-bill, we've seen a lot of buying as we expect a maturity, T-bill's maturity on Thursday, about 71 billion will come into the market. So traders have seen the foresight of buying to investors funds coming in. And the long end of the curve, we've seen a bearish prayers. We've seen people take profit taking, and then the auction calendar has just been recently released, showing that the BMO will borrow about 130 billion at the next auction.
Now, in terms of liquidity, what are your expectations?
The market is going to remain fairly liquid as banks are keeping money for any FX auction so that they won't be caught away. We've seen a lot of people a lot of banks slow down in purchase of assets in the market.
Right, thank you very much for your time, Chioma Udu from GT Bank. We move on now. Shell Nigeria Exploration and Production Company has halted production at Nigeria's Bonga oil field for maintenance that will last at least a month. Bonga, which has capacity to produce 225,000 barrels per day of oil and 150 million standard cubic feet of gas, is expected to resume production at some point in April. Market sources had expected work on the field because there were no exports planned in March, compared with typical exports of roughly 200,000 barrels per day. Bonga produced an average of 192,500 barrels per day of oil in 2015. And in Libya, battle over the two largest oil ports continued on Monday as the Benghazi Defense Brigades widened control over the area. The BDB took control of the ports on Friday, March 3, from eastern-based Libyan National Army, who had been controlling the ports since September 2016. Libya's oil production has recently been around 700,000 barrels per day, but has dropped to 663,000 after Waha Oil Company cut output by about 35,000 as a precaution due to the unrest. We'll take a quick break, and when we return, of course, we'll look at the world of oil. To stay with us.